But with gold also a foreign exchange cross against the dollar, the Fed relies on paper gold to manage the dollar against gold. And this is what led them into making this catastrophic error in March 2022, when they employed paper gold to fight against Russia backing the ruble-denominated energy trade with physical gold. And get the difference. The Fed was selling paper gold while Russia was accumulating physical gold in exchange for oil commodities, severely impacting this 100-to-1 ratio. So you've got a double whammy going on here. And this ill-advised sanction pushback evidenced the Fed taking on the entire load of these paper market short bets, with every single other central bank except the Fed shedding paper gold exposure against themselves.
In a recent discussion, AndrewMaguire delved into the intriguing dynamics influencing gold prices, shedding light on the ongoing bullish trend and its underlying drivers as we approach the end of 2023. Maguire's insights harkened back to his earlier predictions at the beginning of the year, particularly regarding the potential impact of Basel III NSFR compliance. On its upward trajectory, gold reached a 3-month peak last Friday, marking a second consecutive week of gains. It's a remarkable turn of events, especially considering that in 2020, gold experienced a significant 28% price surge. However, in the subsequent years, from 2021 into 2022, the price of gold has remained relatively stable. One noteworthy aspect that Maguire points out is that gold is now increasingly perceived as a competitor to US Treasuries. It is traditionally considered safe, but with risks due to its substantial national debt. What's often overlooked in gold market analysis is the role played by the Bank for International Settlements, BIS, which operates as a crucial intermediary in central bank gold trading. Maguire emphasized that since November 2022, the BIS and most global central banks have been favoring higher gold prices. In other words, they are actively interested in boosting the value of gold. Contrary to conventional wisdom, evidence suggests that gold consistently weakens in response to federal funds rate hikes or changes in Treasury yields. Notably, the Federal Reserve initiated its most recent cycle of rate hikes in March 2022, just after Russia's invasion of Ukraine had disrupted global stability and sent gold prices soaring. As the Fed committed to a sustained program of rate increases to combat inflation, gold prices indeed experienced a decline. Maguire emphasized that the actions of the Federal Reserve in the gold market might be causing imbalances and, intriguingly, creating investment opportunities for those keen on precious metals. Before diving into Rick Rule's insightful interview, subscribe to our channel and give this video a big thumbs up.
The Fed openly intervenes in the dollar crosses. Of course, they do in all the foreign exchange crosses, whether it's a dollar, euro, dollar yen, whatever it is, on a regular basis. And in compliance with each other. But with gold also a foreign exchange cross against the dollar, the Fed relies on paper gold to manage the dollar against gold. And this is what led them into making this catastrophic error in March 2022, when they employed paper gold to fight against Russia backing the ruble-denominated energy trade with physical gold. And get the difference. The Fed was selling paper gold while Russia was accumulating physical gold in exchange for oil commodities, severely impacting this 100-to-1 ratio. So you've got a double whammy going on here. And this ill-advised sanction pushback evidenced the Fed taking on the entire load of these paper market short bets, with every single other central bank except the Fed shedding paper gold exposure against themselves. Gold rising, a rise in the gold price is never really looked on favorably by the Fed insiders attempting to cap gold in the paper markets. This management is reliant and limited on how many speculators can take the bait. I just want to make it so clear so people understand it's that simple. The Bank of International Settlements actually enforced against them and against everyone else the necessary Basel III NSFR structure required to recategorize physical gold as a first-tier asset class. But in order to qualify as a first-tier asset class, the Bank of International Settlements had to ensure that the global liquidity providers who make these markets in this 10 times larger than the Comex foreign exchange gold marketplace had to have physical gold to back up their offerings. Otherwise, how could it be considered to be a first-tier asset class? So since November 2022, the Bank of International Settlements, with every other global central bank except the Fed, want a higher gold price, as does every single bullion bank, without exception. So this beggars the question, why the heavy action in September? And what was missed by the mainstream media, and goodness me, watch Bloomberg all day, you listen to this stuff. No, the only time they ever mention gold, it seems, is if it's coming down. And even with the current geopolitical escalations, how rarely gold, in fact, gold doesn't get mentioned. And what is missed by this mainstream media, and of course the bought and paid for analysts, is that gold now competes with treasuries. This is the key. And given the tail risk associated with treasuries, namely insurmountable debt backed by faith alone, first-year physical gold has become a central bank and sovereign and institutionally sought after risk asset class. It competes. And it provides global central banks and sovereigns, and those simply hedging risk, a far superior and the only zero counterparty risk asset class anywhere. And really, what this is doing, it's foretelling us. This is a change. This is foretelling us the coming of a new world monetary order. And we are privileged to be witnessing this inflection point where Nixon's temporary suspension of the dollar's convertibility into gold some 52 years ago has been reversed.
In the latest Comex gold market update, the front-month Comex gold for October delivery showed significant gains, surging by $32.60 per troy ounce or 1.7%, ultimately reaching $1,955.30. This positive trend marked the second consecutive session of increases, indicating a growing bullish sentiment. Maguire emphasized the importance of transitioning from a predominantly paper gold price system to one incorporating deliverable gold prices, signifying a potentially substantial change in the market's operations. Meanwhile, the address by Federal Reserve Chairman Jerome Powell at the Economic Club of New York on Thursday has a profound impact on gold futures within the Comex market. As a result of Powell's speech, gold for December delivery experienced a significant rally, ultimately settling at $1,980.50 per ounce, reflecting a solid 0.6% increase. Maguire further highlights that the Federal Reserve and the Comex market could be at a critical juncture, facing a potential crisis. Let's get back to the interview.
The problem for the wrong-footed Fed, which is, as you say, the only central bank still net short paper gold. Their efforts to continue to concoct a synthetically priced gold benchmark to support treasuries and the fiat-backed dollar is this foreign exchange markets. They rely on ensuring that this Comex-derived gold price continues to be siloed and squared inside this non-delivery Comex bubble. What spills out is a problem. And while the House can rig the shorter-term ranges, for the first time in LBMA's history, liquidity providers report that so much of this fractionally held bullion underpinning the leveraged casino chips loaned to the speculators, which is measured in CME terms or Comex terms as open interest, but it's just chips. So much of it has flowed out of the CME LBMA ring fence that there is insufficient remaining paper market liquidity to keep this 50-year confidence trick running for much longer. This is telegraphing, as we enter 2024, the plus 50-year Comex dinosaur will no longer be fit for purpose. It has reached an inflection point where it will either have to reflect a deliverable gold price, or, and it could be silver, or it'll be robbed of every leveraged ounce. Really, where's the solution there? Of course they don't want to fail. They'll have to back it. So faced with this situation, and the Fed relying on this market to contain paper gold, what are their options? So really, they've got some choices. Adding paper market open interest, adding more than can be laid off on the captive speculators, will result in this excess leveraged non-delivery paper warrants being EFP. Do you remember EFP is 60 in exchange for physical? It's a little back door that the Comex has. If I want to take delivery, I want to take a Comex position, I can move it into the deliverable markets through the EFP backdoor. We see tons of it going on. People don't realize what's going on here. So, because what's happening is then, if you put too much out there, then these warrants then are converted into physical in the NSFR compliant Basel III physical delivery markets. Hence, the Comex market making insiders have to literally race in to ring the register on the speculators far earlier than they would have liked, really limiting the scope of these counterintuitive sell bots. And they are bots. They're high-frequency trading bots.
In light of these developments in the gold market and the potential for significant changes, how will the dynamics between paper gold and deliverable gold prices evolve, and what impact might this have on investors and the broader financial landscape soon? If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.